Good afternoon, everyone, and welcome to 39th webinar by Sustainability Reporting Standard Board. And today's topic is sustainability reporting and greenhouse gas reporting. Friends, all of you are aware that the importance of sustainability increasing day by day. And as our Prime Minister, Honorable Prime Minister, has announced to make India net zero by 2070, and all the regulatory requirements also fall in line with the same. And as our sustainability board of ICI is pioneer in the world, we do lot of initiatives in consensus with the national objectives. And as regards to reporting, we support the regulators and also do capacity building for our members. As discussed, this is the 39th webinar, and every Thursday we have the webinar series. We are coming out with various certificate. We have a certificate course on BRSR and sustainability reporting, where more than 2,000 members have already cleared. No doubt, this is very niche area, but very super specialized subject and having a great future. Friends, today we have with us CA Rajendra Kumar P. Also, he is our senior Central Council member and also honorable presiding officer of Board of Discipline. And I have a privilege to have him as a presiding officer in BOD, and also he is a GST man, we can say. He's heading GST committee of ICI also. And as a BOD, I would say that I have learned a lot of things under his guidance, and he is my guru at ICI as a regulatory functions of disciplinary is concerned. And it is always privilege for us to have him over here at this webinar to share his words of wisdom. So I request Rajendra Kumar P. Sir, we call him as a RK Bhai, to please come forward and share.
Thank you, Priti Ben, the chairman of this one of the very important boards of ICAI. In fact, Priti Ben is also the member of the board of discipline of ICAI consecutively for the last 3 years. There is an achievement because she is the first woman on the board of discipline of ICAI as a central council member. And she is the first lady also to complete 3 consecutive terms in the Board of Discipline of ICAI. In fact, Board of Discipline of ICAI does a lot of work with respect to the disciplinary matters of ICAI, dealing with all not guilty cases with first schedule, miscellaneous matters, withdrawals, and also matters which are not properly filed with the board, and so on and so forth. So her contribution in making the board vibrant, her contribution in making the board historic for its achievements is extremely immense. So thank you, Priti Ben. And esteemed friends, this sustainability board of ICAI, this today's topic is very interesting with respect to greenhouse reporting. She was talking about greenhouse reporting. In fact, when I hear about greenhouse reporting, I hear about carbon dioxide, methane, nitrous oxide, and almost gases like HFC and so on and so forth. And the GHG protocols that you call in the greenhouse reporting occupies a very significant reporting aspects because you see the direct emissions, indirect emissions, and the footprints that we leave on the globe are all part of these reporting standards. And ICAI, under the leadership of Priti Ben, has really flowered this particular board, the Sustainability Reporting Board. In fact, I have known Priti Ben as a very active, what I can say, a vibrant member, and also very active in this particular part of the field, which is sustainability. In her leadership, under her stewardship, She's also holding many other hats. She's also wearing the hat of the chairperson of the Women's and Young Members Empowerment Committee. And very soon, the Women's Awards selection process is going on. And whoever are the women in this particular group who are attending this participation today, you may certainly ensure that you apply for the awards and see where you stand for yourself. Friends, I also greet the speakers who are come here today to share their immense knowledge. I greet them and thank them for sparing their valuable time. I mean, these are all new niche areas. Time tested ones of audit, accounting, taxation are all there. In fact, these are niche areas. And in a food, if you have, let us say, dal chawal or bisi bele baat, the side dishes which are served are like the sustainability, the things like greenhouse reporting. They make the food tasteful. They enhance the taste of the food. They enhance the reputation of the person who has cooked the food. Also, it is required. You can't discard it. Similarly, to make a greener world, to ensure that the world is better place to live, these type of standards, these type of large steps, the giant leaps are required. Why did dinosaurs become extinct? Is one question many ask. Maybe people like Prithiben were never there those days to teach about sustainability, etc. Had they been there, but then at least I can tell you one. She's a dinosaur of sustainability reporting standards of the world today. She's a giant in herself. So, friends, let us indulge ourselves in this program. And sincerely thank you, Prithiben, for giving me this wonderful opportunity to come to you, come to your committee, and also to meet all these young people, Ankush, Tanuka, Kinjan, Namrata, and all the young people of this particular team who are going to be holding the fort today. Thank you very much, and best wishes to each and every participant in whatever occasion, in whatever field that you are in. Thank you very much.
Thank you very much, RK Bhai, for sharing your words of wisdom. And we can always say the culture of India is like that to be sustainable because basically bhat or rice, whatever we serve, predominantly we are served on banana leaf only, which the culture is now adopted by the European countries. So, as a India, from beginning, we are actually being sustainable. So thank you very much for giving these kind of examples and sharing your words of wisdom. And the work which you are actually doing for the institute is really a remarkable and taking the institute to the next level. Thank you so much. And we have with us today's faculty, Namrata Motiramani, who will be taking us through the session on sustainability reporting. Friends, reporting is in India majorly is like as per the requirement of a SEBI is business responsibility and sustainability reporting. However, world over there are various other reports like GRI or say sustainability standards and TCFD. These kind of reports are there. She'll be taking us through this journey. Greenhouse gas emission, the calculation part, we have all from the board, we have released the calculator, carbon emission calculator, which is available on the website of institute also, that is sustainability board website also. One can go and actually click and understand what is a carbon emission from their office, from their home, which is available free of cost to all the members and public at large. So all these things will be covered, and I really welcome Namrata and the moderators Kinjan and Ankush for sparing their valuable time on this Thursday afternoon to moderate these sessions. With this word, I hand over the charge to the moderators. Thank you so much.
Hello. Yeah, good afternoon. Good afternoon, everybody. So I would like to introduce, it gives me an immense pleasure to introduce Namrata Motiramani, who is today's speaker. So she has Namrata is a sustainability enthusiast with an outstanding academic background and global exposure in the field of ESG. She holds a bachelor degree in engineering and MBA in sustainability from the Netherlands. She has 6 years of experience in the area of strategy, consulting, SDG compliance, project management, renewable energy, power trading, green technologies, and more. Having worked in diverse industries across two continents, she brings a unique international perspectives and expertise in implementing sustainable practice across various sectors. She has worked as a class 2 officer engineering with the government of Gujarat before moving abroad, where she was working as a SHE, that is Safety Health Environment Specialist at a German FMCG called Henkel. Currently, she's part of INCOP ESG team working with clients from different geographies to achieve the ESG goals. In her free time, she enjoys volunteering and reading. She is passionate about traveling and has explored more than 20 countries till date. So welcome, Namrata. You are speaking.
Hi. Yes. Thank you. Thank you for such an elaborate welcome. Thank you so much. And I'm really honored to be a part of the speaker here. And I'm really excited to take you through my 2 cents on the sustainability landscape of the nation. Thank you. Should I directly start by sharing my screen?
Yes, please.
Yes.
Yes. Once it's visible, please give me a heads up.
Yes,
it's
the screen is visible
Yes.
now.
Okay, perfect. Oh, I should directly. I thought it would start as a slideshow. One second.
Yes, sure.
Yes, the slideshow is visible now, right?
Yes.
Yes.
Good to go.
Yeah, thank you. Welcome, everybody. And we have got next close to 1.5 hours to discuss about sustainability reporting and greenhouse gas reporting. And I would directly jump in. I actually had prepared a speaker slide, but I don't need it now. So I directly jump into the agenda. And we will start today by setting up the context. How sustainability is currently being integrated into business, why it is needed, and why all the reporting laws, standards, why are they coming up? So we'll start by there. We'll then go through what is the history of sustainability and ESG reporting, laws, frameworks, and how it has evolved over the past few years, how we are expecting it to go further. We'll then go ahead and check a little bit about, we'll go a little bit deeper into the greenhouse gas accounting and reporting. It is also kind of a part of the ESG reporting, but still we'll go deeper into that separate reporting part also. And we'll also see a little bit about how technology is shaping up the disclosure process. And lastly, we'll wrap up with concluding remarks and key takeaways, and we'll have some time for the questions. And if you have any questions, meanwhile, I do not know how the system works, but maybe you can send in the questions and I can see and I can answer. Yeah. Perfect.
If there are any questions, then I'll definitely pitch in.
Yes, sure. I'll maybe wait after each section.
Yeah, no problem. I'll once complete. Yeah.
All right. Thank you so much. So going ahead with the first section of our today's session, we need to understand what is the need of integrating sustainability into the business. I'm pretty sure you've got 38 webinars before this, so you pretty sure know this, but I'll just quickly skim. So first of all is, of course, we as people are damaging the planet. And if we are running a business, then we have to focus on people, planet, and profit, all three. So that is one where we shouldn't be harming the environment in general. We should be able to use the resources right now in a manner that the future generations are also able to use it. That is, of course, the first part of it. Second part of it is that the investors are currently interested a lot in how your businesses are affecting the environment. So it's not just about you should be doing good, but the investors will force you to do good to the environment, and they'll force you to take up the responsibility. And for that, they will check on you. You will have to disclose all your impacts. You will have to just give them that report, and that's when they will invest in your company. So the second major driver is the increasing investor interest in sustainability integration into the business. And also in general, because everybody's doing it, so you have to do it if you want to remain in the business. So all the companies in general, people in general, employees in general, are customers in general are interested to know what you are doing, how sustainable your company is, how you are giving back to the society, how you are taking care of the environment. So that is one thing. And also the laws will enforce you to do it. So this is just a basic understanding of why businesses are needed to incorporate sustainability measures in their business. Yeah, these are the three pillars. Sustainability is kind of a term which refers to the business strategy, focuses on three pillars: economic, environment, and social, and it kinds of needs governance as a base for it. So although we call it ESG, governance is more or less the base of the whole process. And why the reporting matters today. So it's not just enough that you are doing something good for the society, you are taking care of your employees. That is not enough. You need to let the people know. You need to let the investors know, stakeholders know what you are doing. So that is why the disclosures are important. And globally, all the companies are moving towards disclosing the impact of their processes, of their companies and products. So you can see here that 96% of the global 500 companies have published the reports in 2022, and which was 86% increase from 2018. So you can see only in 4 years, the increase is manifold. And it is just going ahead with a crazy speed. It's not just now the global top companies, multinational companies, it's also trickling down to the downstream supply chain and the upstream suppliers. So even if you're a small supplier, but if you are anyway related to the Fortune 500 companies who are mandated to do the reporting, you will in a way, you will be contributing to their scope 3 emission. And that is why you will also at some point need the reporting mechanism in place. Yeah, all the numbers you can see, 14% is the growth rate, year-over-year increase in the sustainability reporting adoption. And you can see what is the market impact. It has been researched that the companies with strong ESG disclosure practice experience 20% lower cost of debt financing. So as I said, the investors, the banks, they're interested in knowing, and they would be giving you interest at the lower rates if you are reporting your sustainability measures properly. Going ahead, how did the sustainability reporting go from voluntary to mandatory? So earlier, everywhere across the globe, in Europe as well as UK, India probably would enter late in the race, but they all started in the West, the countries started a bit early, and they were voluntarily advertising what they are doing for the environment. And that's when it all started, from voluntary disclosures. But now in 2025, it is no longer voluntary. There are already in India, we have BRSR, which is mandatory for top 1000 companies. And likewise, all the countries are now kind of mandating global level as well as at the national levels. They are mandating the sustainability reporting frameworks. And you can see on the screen that Europe did CSRD. The US is doing SCC climate rules. UK is doing the TCFD aligned mandates. And there are many more, like smaller countries like Australia. They're all also doing IFRS-based mandates. And India is doing GRI-based mandate. So these are all these mandates that are coming. And slowly and gradually, all the companies, it is going to trickle down, and everybody is going to be mandated to report their sustainability efforts. Yeah, now that we have set the context, now we'll go ahead and see how the landscape has evolved over the last few years. Actually, last many years. So it all started, as I said, it started in the West. GRI was the first such initiative. It started actually in Amsterdam. I was also in the Netherlands, and the place where I was doing my master's, that was the place where GRI was headquartered. And slowly and gradually, there were a lot of frameworks that kept on coming and kept on kind of merging with each other. So once GRI started, there was this integrated reporting framework, IR framework, that came into practice. Then there was TCFD, which is Task Force on Climate Related Financial Disclosures, where it was the first time where financial aspect was linked to the sustainability aspect. Then came the SDGs, United Nations SDGs, CSRD, then IFRS and S1 and S2. It is also once again finance linked with ESG. So these are all the international frameworks which kept coming. And if we focus on the Indian regulatory frameworks, 2011 was the first time when voluntary guidelines were issued for reporting. Then in 2012, SEBI mandated the BRR, it was Business Responsibility Report Framework. Then the Companies Act CSR rules was introduced in 2014. Then again, 2017, the IR was incorporated. And right now, 2021, as of 2021, BRSR is mandated in India for the top 1,000 companies. And there are some core parameters which are just which are compulsory for those companies. And the rest are leadership voluntary disclosures that they can also do. So this is the Indian regulatory framework. And if we go deeper in how it was done, how it was done for India. So this is just, these are the levels across which the companies can identify where it will be beneficial for them to start doing ESG reporting. So one is the reporting mandate, which they have to do, the environmental laws, social laws, and the governance laws. They compel the companies to have certain rules in place, and they compel the companies to report on certain core aspects under BRSR. And then the assurance comes. Again, it is mandatory for some, but not for everybody. And the ESG ratings is one such thing which affect the company's well-being and their goodwill in the market. Later comes credits. If you know what are the there is some kind of mechanism where if you are doing very good for the environment, if you're generating less carbon than your industry in general or in your company in general is allowed to generate, then you can also register for carbon credits. You can register for green credits. If you are generating more renewable energy than your peers, for example, you are also allowed to register for renewable energy credits and you can trade for them. So it also kind of gives you a monetary benefit in that term. And lastly, of course, the finance is available to you at a lesser interest. The investors will be interested to invest in your company. The banks will give you lower interest rates and the green bonds. All such things are what are compelling the companies today, in Indian companies today, to move towards sustainability reporting. I will now jump into just the basics of course, everybody here probably is a CA and you do accounting, financial reportings and day in, day out. So sustainability reporting is also in a way similar. You can also kind of do integrated reporting, but there are some factors which are different than the financial reporting. So the first is control versus influence. Like in the financial reports, you report about all your entities which are in your control, all the assets that you own. So you are supposed to report all the profit and loss and all the process and everything about those assets. Whereas in ESG reports, or non-financial reports, you are supposed to report about what influence you have, what impact you are having on any entity, which may or may not be yours, may or may not be directly impacted by you. But that is how you're supposed to, the control and the boundary that is different in financial and non-financial reporting. Second is quantitative versus qualitative. Whereas financial reports are mostly quantitative, the non-financial ones are mostly qualitative. So dealing with both quantitative as well as qualitative data requires expertise, and you already have that quantitative expertise. So now you just have to build a little bit of qualitative expertise, and then you can probably do the whole integrated reporting for your clients. And yeah, the last difference is that whereas the financial reports are historical, where you are reporting on the past data, past 1 year, and whereas but the non-financial reports are generally forward-looking. You will also be reporting on what you did last year, but mostly you will be reporting on what you are planning to do next year, what plans you have for the upcoming time in the long run. So this is just core difference between financial and non-financial reporting. What are the key aspects of ESG reporting? There is a materiality assessment that goes into identifying the risk areas which your company has with respect to E, S, and G parameters. So materiality focus is something that is needed, because you cannot just go ahead and actually this also helps the companies about where do you want to start. You cannot just go and randomly pick areas which you want to focus on. You have to have the idea of what is more important to you and what is more important to your stakeholders. And that's how you should be reporting. So that is what truly matters to the stakeholders. And you have to be aligned with some frameworks. Either you can develop your own framework, or you can accept or adopt some globally accepted framework. That is one thing. Then you should have a balanced narrative. You shouldn't be very optimistic, or you shouldn't be very pessimistic while you are making promises or building targets. Then you should be linking ESG performance to long-term value creation and risk management. So rather than just doing something which is good, which will look good in the numbers in this year, you should be focused about how long-term they are going to affect. And you should have clear KPIs, and you should have clear progress against those KPIs. So you should also have the baseline clear about what is your base year for which you are making the targets, and you should be reporting the progress every year until the next. Probably you have committed that you'll be going net zero by 2050. So it's not just, okay, 2050 you're set and you're not telling them what you're doing. You should actually tell that, okay, 2045 we'll reach here, 2040 we'll reach here. And you should also report the progress. If you're not meeting the targets, that's also something that you're supposed to report. And not just reporting, not just, you would have all heard about greenwashing probably. So greenwashing is nothing but you are committing something, but you are not actually practicing it properly, or maybe you have found a loophole to do it. So it's not just enough to promise and commit. You should integrate ESG into your core strategy and governance structures and practice the same. So reporting is not just reporting, but also everything in the background. This is actually a bit deeper into how you can identify the risk areas. I'll just quickly skim through. So there are some internal stakeholders of your company who are the employees, managers, owners, and the external stakeholders, which can be suppliers, the society, government, the investors, the shareholders, and the customers. So it's both these groups that you are supposed to please. So that is why you should identify the stakeholders, and then you should identify what are the key areas which the stakeholders are interested. So this is actually a step of materiality assessment, and I wouldn't go deeper in this at this point. If we have time later, I'll probably go a bit in deeper. And again, yeah, I'll directly go to the materiality assessment. So materiality assessment is something that you are needed to do in order to identify your risk areas, and in order to set targets, do measurements, do calculations, and then set the targets and report the same. So for that, 2 categories of materiality is assessed. So first of all, you are supposed to identify how your business is affecting the environment. So basically how the effect is going from your company to the outside environment. And the second is how the outside environment and society, they are affecting your business. So you're supposed to do this check both ways. inside out and outside in. So this is the meaning of double materiality assessment. So that's how you can have a comprehensive idea about what truly matters to your company, your stakeholders as a whole. And yeah, generally, whenever we do materiality assessment for companies, this is based on the GRI principle. So this is how we identify each topic and we put them in this matrix, where on the x-axis we put inward impact of the organization from society and environment, and on the y-axis we put the outward impact, which is on the environment by the organization. So we generally put the risks on this matrix, and whatever comes in high risk on both the ends, those are the topics that we address first. So you can see this top grayed area and the right hand side grayed area. So whatever falls in this block is something that is to be addressed first. But yeah, this is of course a very niche area and we need not go deeper into this. So I will directly go ahead and go into the key features of a sustainability report. So a sample or an ideal sustainability report will have introduction messages from the leadership team of the company, all the CEOs, all the CFOs and all the leadership owner, everybody. That is how generally it starts. Then all the social, environmental and governance initiatives of the company will be reported. If there are some impact stories of what they did and how it turned out in the past few years, that is something that you're supposed to report. You probably might have seen a lot of big corporates publish this stories. You probably might have seen the Amazon box also, where the box has the story of the person whose life was changed because of Amazon. So such impact stories also are very effective, and they are also generally included. Case studies or stories, they are also included in a sustainability report. Of course, there is a framework that you have to follow, either your own framework that you have built, or you have to go and pick up some well-accepted framework globally or nationally. And you should have a full account of ongoing and planned CSR activities divided in the areas. I'll show you the next KPI table, and you should have all those KPIs and all the CSR and all the planned activities, as well as all the ongoing activities are supposed to be mentioned. Then you are supposed to do a GHG emission profile, which is scope 1, 2, and 3 greenhouse gas emission mapping. SDG is not compulsory, but if possible, you should also be doing the SDG mapping about which action is affecting which sustainability development goal of the United Nations. Or GRI. You can choose to do GRI and SDG. These are complementary. So you can either do both or you can do one. So we generally in India, they are doing GRI and SDG mapping. So besides that, these are all the reference frameworks: GRI, UN Global Compact, SASB standards, which are IFRS S1 and S2. EcoVadis is the rating platform that also gives you a guidance on how you are supposed to make your policies and all. So these are some frameworks and some helping material which can help you in building a sustainability report. These are the metrics, environmental metrics. I'll go through some environmental metrics followed by the social and the governance ones. So for example, in the environmental metrics, you can have the energy and emission management section where you will report about scope 1, 2, and 3 emissions. You will report about how much renewable energy you are consuming, how much non-renewable you are consuming, and what are the reduction strategies for the emissions and energy. Likewise, for waste, you have to identify what is your hazardous waste, how much is your non-hazardous waste, how you are doing the disposal, and how you are planning to reduce the waste. Same way, water management, how much you are consuming, how much you are discharging, if you are doing rainwater harvesting or not. For the biodiversity and land use, you're supposed to report on ecosystem services management, fair land use practices, and if these are applicable to you, then this is something that you can report on. And around all the environmental metrics, There are some buzzwords which probably you might have heard a lot. So there are net zero targets, there are plastic neutrality target, water positivity targets, there are decarbonization, power purchase agreements. These are all the buzzwords which have come from the environmental metrics. So this is nothing but even if you want to have any such targets, you are supposed to first go through all individual environmental metrics and then measure your impact, plan the reduction, and then finally give such targets out. So this is all about the environmental metrics. Then these are some social metrics that you can report on. The human capital development, about employee well-being, training and development, how you are retaining your, how you are hiring and retaining, what are the benefits that you are giving. Then there is occupational health and safety. There is diversity, equity, and inclusion, human rights, labor practices, community engagement, social supply chain, social responsibility, customer centricity. These are all the bigger titles under which you can identify which are the core material topics for you and what you want to target, what you want to focus on. These are some social metrics which you can target. Then comes the governance matrix. This is a little bit qualitative. You can have some quantitative in environment. You can also have some quantitative measurements in the social, but governance is mostly qualitative. There are some KPIs, of course. So this is related to business ethics, board composition. How is your leadership, corporate leadership? How do you do the risk and crisis management? How do you do the resource allocation, incentive structures? And how do you maintain anti-corruption integrity? How do you how do you protect your customers' data? All those factors come into the governance matrix. I'll go through a couple of examples from the industry. These are some of our clients, and they have mentioned all their. So this is focusing on the social KPIs. So these are the KPIs that they have chosen to report on for the 2023 and 2024 financial year. So these are all their DEI initiatives, how they are taking care of the brand image communication. They've highlighted everything that they have done, whatever is ongoing, as well as whatever has been done in terms of cultural building and awareness, in terms of ecosystem, how they are implementing the policy, how the administration and infrastructure works, how they have created DEI cross-functional teams, and what are the benefits that they had given. These are all the percentages, like how much training was given. So these are some of the excerpts that I have taken from the Deepak Nitrate report. Next, this is a cement industry called Dalmia Cement. Again, they have also identified how many new employees they have hired, how many have left, what is the turnover rate, and what are the initiatives that they are doing, what is the training that they are giving. This is taken from their sustainability report. And this is one more example of ICICI Bank. Here they have developed their own ESG governance framework. So this is their governance structure, their risk committee, their CSR committees, their stakeholder relationship committees. These are all the committees that they have in place. And this is something that they have reported in their reports. So yeah, that's, I think, right. We can take a 2-minute break if you have some questions, any questions till now, and anything. Or if I'm going very fast, very slow, if you want me to change anything, you can let me know. All good? I'm assuming all good. If
As such, we do not have any questions from the participants.
nothing yet? Okay. Perfect. So I'll go ahead and
Just one
Okay.
question from my end, from my side. So just wanted to know, since you are working with ESG standards and frameworks since a very long time, so is there any have you come across any unique practice which any corporate have adopted? Any unique which was an which was very unique and which is good
Okay.
to know.
Okay, I will think about it in the background. I think most of them just do the basic mandatory requirements. There are very few who actually go ahead and do beyond the mandatory requirements, at least in India. So that is something that I do know. But besides that, like when I was working with Henkel, that is where I actually thought that what we are doing is pretty cool. So what we did there was we were working because our water like the product that the company was making was shampoos and detergent and liquid detergent, like all cleaning products. So they were very water intensive, and they were one of the highest users of water in couple of plants that they were operating in. And that's when they came up with dry sheets, paper sheets of detergent and all those things. So that is one thing that they did, so that from being a very high water intensive product, they just went to a zero water product. So that is something that they did, which I found very cool. That instead of solving the water problem, they just removed water from their product. So that is something that they did not just for the reporting sake or something. They actually felt that it is problematic to use more water on these sites. So let us start manufacturing waterless products on those sites. So that was something I found pretty cool. But more or less, currently, wherever I have come across all these companies, I have come across only mandatory initiatives, but not very
So
interesting besides that.
just one thing which I would like to share. I'm working for Kraft Heinz. So this company, Heinz Ketchup, produces Heinz Ketchup and all. So they have come up with an initiative wherein earlier the ketchup used to be in a not a reusable bottle. So
Okay.
now they have come up with a plastic bottle which can be which can be reused.
Okay.
So this is one of the initiative which the company in their inbuilt in the you like you mentioned that there
Mhm.
the products were water intensive, and
Yeah.
now so the same thing with for my company as well.
Yeah, so such initiatives I've seen rarely in Indian companies, to be honest.
Yeah,
But
this is USA. Yeah.
yeah. Okay.
Okay. Yeah. So
Yeah. So can we go ahead?
yeah.
Okay, perfect. So yeah, on the slide you can see some global ESG reporting standards and frameworks, also some rating agencies. So of course, there are a lot. Some of them are widely accepted, some of them are integrated, some of them you probably are looking at it the first time. But I will be covering some major widely accepted frameworks. That is what I'll be covering in the next slide. And I'll be focusing a little bit more on BRSR because that is more relevant for the Indian landscape. And this, I don't really think we should go deeper in this. This is just a list of them, and we can go ahead and focus on some few ones. These are some key ESG reporting standards. The first one is GRI. It is also one of the widely accepted frameworks. The Global Reporting Initiative is the standard which addresses the disclosures of socially material topics affecting a company's stakeholders. It also requires that companies determine the issues that are material in consultation with the stakeholder. This is what I was showing in the previous slide about the double materiality assessment. This is what I mean, that you are supposed to focus on your material topics. For example, if yours is a supply chain company, if you are an e-commerce business, and suppose you leave out your delivery partners commute or delivery partners vehicle usage, fuel usage, if that is something that you leave out of your report or of your calculations, then it essentially doesn't make any sense, because then you'll probably just leave out one scope or one category of scope 3, but you are kind of still not making sense because that is one of your material or one of your key topics of interest. So that is what they mean, that their GRI asks you to identify the material risks and then report on them. Next is the Sustainability Accounting Standards Board. They have come up with their own IFRS 1 and IFRS 2 frameworks. So they were initially doing the financial standards, but they have now come up with the sustainability standards linked with the financial performance also. So that is something that is new in market right now. Then for India, in May 2021, SEBI had introduced new reporting requirements on ESG parameters, the BRSR. And BRSR seeks disclosures from entities on their performance against total 9 principles. And we'll also go a little bit in depth later on. TCFD, yes, Task Force on Climate-Related Financial Disclosures is one such framework that is also, after GRI, I think it's the second most widely accepted frameworks for reporting. And this is IFRS, as I said, they are built under the SASB. And this is a little bit about GRI framework. It is a very intense, very content-heavy framework. And you're supposed to report on total you have to start from the foundation. You have to report some foundational parameters. Then you are supposed to do some general disclosures based on your industry. And then some disclosures are there on the management approach. And based on your industry again, you will have some selected economic disclosures, environmental disclosures, and social disclosures to choose from. So this is all about the GRI standard. And it is a very intense standard, but it does not have finance linked to it. So that is why I believe the GRI is now being taken over by the TCFD, and now it was taken over by TCFD, and now it is further being taken over by IFRS S1 and S2. So, but GRI is still widely in use currently. Then comes the BRSR. It started with BRR actually initially, and then slowly some mandates were added to it, and some compulsory core reporting indicators were added to it. And in May 2021, this was introduced. The structure of BRSR is such: first, again, Section A is the general disclosure, Section B is management and process disclosures, and Section C is the principle-wise performance disclosure. So there you have the essential indicators or the core indicators, and then you have some leadership indicators where essential, as per the name suggests, are the mandatory ones, and the leadership indicators are the voluntary ones. We'll go through some core indicators, the essential indicators. So as far as the GHG emission is concerned, they mandate the Scope 1 and Scope 2 emissions and the emission intensity. For water footprint, you are supposed to mandatorily report how much water you are consuming, what is the consumption intensity, what is the water discharge, your plant-wise water discharge or your factory-wise, office-wise water discharge. Then you are supposed to measure your energy footprint. You're supposed to report on your total energy consumed and how much is renewable, how much is non-renewable, and what is the intensity. Intensity, let me clear for everywhere that you see intensity. You can choose to report either on your employee, so how much total electricity divided by the number of employees, or you can do based on your turnover. So what is the total energy consumed and divided by what is the total turnover that you have. So whatever is more material, whatever makes sense for your industry, that is how you're supposed to calculate your intensities. Then you're supposed to report on waste management. You're supposed to have some core indicators on employee well-being, gender diversity, inclusive development, fairness in engaging with suppliers and customers, and the openness of business. These are the core indicators. Wouldn't go much in deep depth for all of these. Next, we'll go through a little bit on what is TCFD. So TCFD again has 4 pillars. First one is the governance, second is the strategy, third is the risk management, and fourth is the metrics and the targets. So this is one of the widely accepted frameworks, which is also used widely in India. And some of them, you can see that Hong Kong has made the climate related disclosures mandatory. Singapore is planning to do the same. New Zealand Stock Exchange is doing mandatory. So this is also currently being mandated across a lot of countries. And TCFD was further actually picked up by IFRS, and IFRS added S1 to it. So this is about the climate related disclosures, which is covered in the IFRS S2 disclosures. And the other one is the sustainability related disclosures, which is covered in S1 of IFRS. So this essentially gets extended a little bit in IFRS, but the base is TCFD. So this is going to remain in practice for the years to come. Yeah, this is just about how the standardization trends are going on. So a lot of times some new frameworks come and they question the previous ones, and sometimes they are integrated and all those things. But in general, the mandatory requirements are implemented, binding the ESG disclosure laws and across all the countries, across the whole globe. Then there are some standards conversion efforts where they try to have one combined integrated standard that is also going on. So as I said, this ISSP has integrated SSB and TCFD frameworks. So they kind of do cooperation and collaboration to help out the clients. And the last is the anti-greenwashing enforcement. Greenwashing just means that you're not supposed to present something which essentially doesn't make sense. Essentially, you're not following or is giving a wrong picture, a more rosy picture to the investors or to the customers. So this and greenwashing is linked with heavy fines, heavy debts across the globe. Yeah, so this is all about the sustainability reporting frameworks. Yeah.
Hello.
Hello.
Yeah, Namrata, we have a question. How can one spot greenwashing in ESG reports?
Yes, this is a good question. And you would be actually surprised to know that we have had scenarios where the competitors go through the reports of their competitors to spot discrepancies, to spot greenwashing. So you will probably think, okay, who is interested in doing so? So the first person who is interested is your competitors. So this is one thing. So it's very easy to spot greenwashing because these are like this is as good as if you are reporting something wrong in your profit and loss statement, and some other accountant or some other CA would know that, right? So the same way, if your ESG manager or your ESG consultant has tried to convey something, but the other company's ESG consultant would know that this is not true. So that is one of the main, I think, ways to one of the main reasons that you should avoid greenwashing. And in general, I agree, for a normal person, it is difficult to figure out greenwashing to a certain extent. So only if it is going to be very big, only then it is going to come into a picture. But no company will do such a big blunder in reporting. And if they do, there are some companies who have done that and they have faced heavy fines. So yeah, I think that answers your question, that somebody will spot it.
Okay, so you mentioned that some companies have done it and they have faced heavy fine. So can you just give us, as in one example, wherein you have read or
Yes. Recently, I read one article on one of the, I do not remember the name of the company. Let me come back to you on that.
No
One of
problem.
the, yeah, very recently I read an article and they faced heavy fines. So
Yeah, no problem. Yeah,
give me some time to come back on that.
no problem.
Yes, okay. So next, we are going to go ahead and talk about greenhouse gas accounting and reporting. What are the building blocks of the greenhouse gas accounting? So we'll answer 3 questions here: why, what, and how. So why greenhouse gas accounting? So naturally, to address the climate crisis. Then secondly, because the regulatory mandatory reporting requirements are there. Third, because you want to do net zero commitments. So there are country-wise net zero commitments. There are company-wise net zero commitments. So if you want to do any kind of net zero commitments, you should first know how much emissions you have, and that's when you can actually go ahead for the next steps. So if you want to have net zero commitments, you need to do the accounting first. Then there are expectations and pressure from stakeholders. And lastly, because it's one of the sustainability related best practices. So you should know your emission. That is one of the best practices. Second, what is GHG accounting? So greenhouse gas accounting is nothing but accounting your scope 1, 2, and 3 emissions as per the GHG protocol. How do you do it? So one of the methods is to use the GHG protocol, which is one of the most widely accepted and used methods. Second is there are some ISO standards, ISO 64, ISO 16064. There are some industry sector specific guidances also. And there are some emission factors for industries or sectors or products, which you can use to estimate your emission. In the start, they mentioned about the SRSP has also come up with a calculator. So that is also one such estimation methods. So this is how the GHG accounting happens. What are the key drivers of the accounting? Again, some people do voluntary carbon reporting because it's best practice and because it's a leadership indicator of the VRSR. And a lot of frameworks would need you to do it. So second is the regulatory reporting and policies. There are many mandatory carbon accounting. For example, in India, BRSR is BRSR mandates scope 1 and scope 2 under the core indicators. So that's why you're by default supposed to account for scope 1 and scope 2. Then there are some net zero commitments and emission reduction strategies that you want to build. There are some strategic imperative board and other stakeholder expectations that you should be carbon neutral, you should be having transitions, also those things. So these are some key drivers of why accounting is needed in the first place. Now, these are some principal GHG accounting standards. So the first and foremost is the GHG protocol. So if you go, this is a little bit in depth. We do not need to go so much in depth about what is life cycle assessment and what is product carbon footprint and all, but we can just understand that GHG protocol and ISO 14064, they are the two accounting standards, we can say, for the greenhouse gases. And these are some of the standards for LCA, which is also in a way related to the GHG accounting. But we'll just go through the main ones, which is ISO 14064 and GHG protocol. So these are the two majorly accepted and widely used standards. I think we won't go a lot in depth, but I'll just tell you a little bit of basics. For both of them identify that there are some direct sources of emission and there are some indirect sources of emission. So while the greenhouse gas protocol identifies them as scope 1, all the direct greenhouse gas emissions are identified as scope 1, and all the indirect GHG emissions are identified as scope 2. Whereas all the other indirect emissions which occur in the value chain or the supply chain of the company, they come under scope 3. So that is how the GHG protocol identifies them. And the ISO 14064, it identifies six categories, out of which the first category is direct emission, and the other indirect emissions are divided in all the remaining categories. In addition, the GHG protocol introduces the concept of scope 4. It is not an official term yet, but it refers to the avoided emissions that occur outside a product's life cycle or a company's value chain. So whatever is not covered under scope 3 will be covered under scope 4, but it is of course far off in the future. But this is something that they have already introduced for all the companies that probably have mastered their emission calculation in the first three scope 1, 2, 3. Then they can go ahead and check their scope 4. So this is just a little bit of basic about how the GHG works. And if for your company you want to identify which one you want to pick up, do you want to go ahead with ISO 14064 or do you want to go ahead with the GHG protocol? Then of course it depends on what you want to do, but the bottom line is that GHG protocol is a lot cheaper and faster for the corporate reporting mechanism, whereas ISO 14064 is more expensive but legally defensible. So if you need some certification, so ISO is essentially, it needs certification, so it's very expensive. But if you want to present a certification somewhere, then you need to go for it. But otherwise, for your own sake, it's faster to implement. GHG is faster to implement and cheaper to implement and easier to implement. So that is the bottom. Also, yeah, I don't know if I've covered, okay, I've not covered it, but the GHG protocol as well as ISO, they are both well accepted by BRSR, whereas there are some upcoming standards such as EcoVadis, which identifies GHG protocol more than the ISO, and there are few more which identify GHG protocol more than ISO. But anyways, I think 2 months back, somewhere in first week of September, ISO 14064 and GHG protocol, they actually did a collaboration. They have joined hands and they are going to come up with some consolidated, integrated standards now. They will probably be out somewhere in 2026 or 2027. So until then, you can decide which one you want to follow, but otherwise afterwards they will have one integrated standard also. Yeah, these are some methodologies that refer or they align with the GHG protocol. The Science Based Target Initiatives, Carbon Disclosure Project, the GRI. These are not specific to India, but these are some of them which identify the GHG protocol. Now, you might have come across a lot of such figures when you talk about scope 1, 2, and 3. So, but this is just a basic. I'll go through quickly about what scope 1, 2, and 3 mean. The scope 1 talks about the direct emissions from the owned or the controlled sources of the company. So if a company is owning the office, if they're owning the plant, if they're owning some vehicles, all those assets collectively, whatever emission they're causing, will be considered in scope 1 for the company. Scope 2 is indirect emission from the generation of purchased energy consumed by the reporting company. So whatever energy you are purchasing for, say, electricity, say steam, say fuel, say heating, cooling, whatever. So whatever you're purchasing for your operations and whatever emission is generated at that end is considered in your scope 2. And all the other scope, all the other emission besides 1 and 2, everything that remains, upstream activities or downstream activities, will be calculated as scope 3. So these are all the indirect emissions that occur in the company's value chain, may it be the upstream activities of the travel, waste generated, purchase good, everything, as well as the downstream activities of use of sold products, investment, lease assets, end of life cycle treatment for sold products. These are all that are covered under scope 3. That is why scope 3 is very complicated to account for and needs a lot of data management and ESG tools. So that is a bit complicated, and that is why it is under the leadership indicator for BRSR currently. The next is a more detailed explanation of scope 1, 2, and 3. So this one is isolated. This one stands for true for isolated company, but no company is isolated. Any company would be getting some raw material from somewhere. They would be then selling their finished products to somebody, and for them this will be a raw material. So that's how the supply chain works, and that is why it is very important for your company to know the activities and the emission generated by your suppliers, because they in a way account to your scope 1. So this series, this chain just goes on continuing until the end user, until the end product is in the landfill. So that is why all the companies, even if you are not under the mandatory requirement, will be required to do all the calculations, because your suppliers who are supposed to report will ask you to report. So that is one such trickling down effect which comes in the reporting and the GHG emission reporting. Once again, this is just an overview of what is included in Scope 1, combustion of fuels, emission from production of chemical and material, fugitive emissions. These are all included in the direct emission, Scope 1. Then the indirect emissions are Scope 2 and Scope 3. And the Scope 4 is the emission reduction or avoidance, which is not officially included in the GHG protocol yet, but will probably be soon incorporated. What is the process of doing the emission and the reduction? So it starts from GHG accounting. Then you are supposed to report and validate it. And third is reduction and performance monitoring. So first of all, you will be identifying your operational boundaries. You will be identifying all your source, all your inventory, then you will categorize all of them by scope. Then you will be selecting a quantification method. As in, how are you supposed to do the estimations? Do you want to do it on actual product base, or do you want to do an estimation? Do you want to do a spend-based method? There are a lot of methods to calculate the scope 1, 2, and 3 emissions. So whatever kind of data you have in place, accordingly, you can choose a quantification methodology also. And then comes the difficult task. Actually, no, the data collection is more difficult than calculating the numbers as such. So this is the first part for GHG accounting. Once you know what is your emission, what are your carbon numbers, then you are supposed to go and do the reporting. So once you do the reporting, some of the companies also like their targets to be validated by SBTi. They also like their numbers to be validated by a third-party auditor. So if that is required, assurance and audit is required for your company, or if you want to do it voluntarily, that is the next step. And the third step is to now that you know the emissions, now that you have validated it, the third step is now to set the baseline year and then set up your targets of reduction. So this is a continuous cycle. This will just go on and on unlimited until the unlimited time. So this is the process of accounting and reporting. I'll run you through the basic principle of GHG emission calculation. So essentially, all the scope 1, 2, and 3, whatever is calculated in this manner. So you are supposed to know your primary or secondary activity data. For example, you have stationary fuel combustion or mobile fuel combustion. So this is the fuel that you have in, say, kg. Then you will have an emission factor, which is either calculated as per your, if you know the source of the fuel, if you know what is the emission factor for that fuel from where you are purchasing it, then well and good. But if you don't know, then there are some global and national databases from where you can get the emission factor. So you will be multiplying that number with that emission factor, and boom, you get the emission. It's as simple as that if you put it this way. So for the electricity or the heat, if you know the number of units that you're purchasing, you just have to multiply it by the unit by the emission factor for the electricity, and you get your emission. So it's as simple as that. Essentially, this is the scope 1, scope 2, and scope 3. But it is not so simple in practice, because you would not, first of all, have this data in place. It's very likely. Secondly, you wouldn't know what is the accurate emission factor. So you'll again need to go research, and you'll have to validate it. And finally, the calculation happens, which is just the multiplication, which is the easiest part. Next, I'll tell you some emission factor databases which are available. There are some regional, global, universal, and LCA databases that are available. open. These are all open databases. One of them is DEFRA, this Department of Environment, Food and Rural Affairs. So these are all in the global databases which are accepted universally. You of course have to go and check which is the most suitable for you. And it is advised to take a balanced approach. It's advised to not go for the very optimistic factor as well as not for very pessimistic measure. So that's why you should be somewhere in the middle, because that's the ideal thing to do. For India, there are some databases. The CEA has come up with the emission factors for the electricity consumption. Then the Greenhouse Gas Management Institute has come up with some guidance on the same. The GIG Platform India has come up. Shakti Sustainability Energy Foundation has come up in partnership with the World Resource Institute. They have come up with a database. Again, National Institute of Urban Affairs. All these have come up with some database, some of them for electricity, some of them for waste, some of them for like general. These are all the databases you can use for India. Next, I'll run you through some key challenges in carbon accounting. I think I've already covered that data collection is one of the major struggles that are encountered for calculation. And there are resource constraints because there are a lot of companies who do not really have the resource to put meters everywhere at all the points where the data is needed. They do not have enough people to do the monitoring. Then some of the companies, they find it very difficult to set the boundary and to set the scope. They are unaware of what are the stakeholder expectations. They are unaware of what are the boundaries, what will be easier for them to incorporate, what will be difficult. And then once they set the boundary, and then they figure out that, okay, this is very difficult to actually get data for this particular item. So then once you collect the data, you have to store it, manage it, you have to analyze, you have to have one common unit of measurement across all your sites, across all your databases. So again, you have to invest a bit in your data management tools, or you will need some external support for the data management. Then come reporting challenges. The data are supposed to be reported in a specific format. So you probably do not have that data in that specific format, and you will have to spend some time, or you will have to get some agencies or consultants to help you out to do the reporting. Then there is the third-party verification, which is needed, which again needs some money and effort and time. They will come and ask you each and every source of the data. So that is again a little bit time-consuming process. And lastly, the supplier engagement. That is one of the key challenges. As I showed in the picture earlier, the scope 3 is becoming scope 1 for somebody, and your scope 3 is becoming scope 1 for your further supply chain. So again, it's very difficult to incorporate these numbers, to get these numbers. And yeah, this is something which requires a little bit of effort. These are specific scope 1, scope 2, scope 3 data collection challenges, but I think this is not relevant right now. And next, I'll go through how technology is shaping the ESG disclosures, because all these data collection mechanisms have some struggles on their own, have some challenges on their own. So that is why there are a lot of data collection softwares and data management softwares, as well as a lot of ESG tools that are helping companies right now. So next, we will go through that. Meanwhile, do you have any questions, any of you? No, I'll assume no. Okay, I'll go ahead with the next topic on how technology is shaping the ESG disclosure right now.
Hello, sorry, I was speaking on
Yes.
mute. I was speaking on mute, yeah. So we have questions, we have certain questions. I'll just so there is one question: how does sustainability reporting strengthen stakeholder trust and board level decision making?
How does sustainability reporting strengthen
Stakeholders trust and board level decision making?
Okay, so For example, say the other day, I was buying a packet of paneer, and I was checking what is the protein content in that paneer. So it said that 33% protein content in the paneer. So, I actually was surprised that no, it's not likely that they have so much of paneer, so much of protein in the paneer, but they are not identifying or they are not advertising it as a high protein paneer. But then once they have written it on their packaging, once it is publicly available, once you have published something somewhere, automatically some kind of assurance or some kind of trust comes with it. Because I know there are some people, there is this food farmer who will probably go and check this, and he'll probably create a havoc if this is not true. So I kind of know that if this is available in the public domain, then this is more trustworthy than if it is not. So similar case, I think, goes with the reporting also. If you have your published audited financial reports, as well as if you have the published audited sustainability reports, automatically people are more likely to trust you than not. So if they have some questions, they'll of course raise them, but by default, expectation will be that this is supposed to be true. So I think that's how it links to the trust. And secondly, board level decisions, of course, the board members are more responsible than anybody else on what is reported in those
Statements.
pages. Yeah, in those reports. So if suppose tomorrow somebody accuses them of greenwashing, then they know that more onus lies on them than anybody else in the company. So they would be more aware, they would be more vigilant, I would say, before publishing the data. So there is less chance of publishing a wrong data, but there is more chance of just verbally speaking something wrong,
Yes.
So I think that's how it also drives the boardroom discussions, that no, this is something that we should check twice before publishing, because tomorrow somebody might come and question it. And it will then impact their whole goodwill, their image. They might face some penalties, some fines also. So that is somebody nobody will risk.
Oh, okay. And there is one more question. So you have already talked about the implementation challenges. This was a question earlier asked. Key implementation challenges faced by the organization while transitioning to structured ESG reporting.
Yes. So I have already talked about how the challenges are, or how many struggles they face for the first time. I would like to, at this point, I would also like to share that one of our clients who has started doing the ESG reporting for the first time this year, and that they are doing because their customer, one of their biggest customers, is asking them to do it, because they are following the EcoVadis rating system, and the big customer that they have are following EcoVadis, and EcoVadis now is also imposed on them, like our client. So they do not have any data in place. They do not even have a count of how much electricity they are using. Like such simple data they do not have in place right now. But they're like, we still need to start because this is something that is required by the supplier. And they have already hired like 3 or 4 ESG managers in their office. They have already put a lot of resource in all the process, but they just do not have the data. So now we are just identifying how they can do estimations based on whatever little data that they have.
Just
And
one
yeah.
just one interruption. So since you mentioned that they do not have data on the electricity consumption, which they do. But generally in electricity bill, we generally get this data, right? The unit consumed for this particular month, or the unit consumed for next particular month. So then
Yes.
that data can be used for our emission details, correct?
Yes. But for this particular client, they do not have any owned office. They are just leasing one floor in a multi-storied building, and that the owner of that building gets the combined bill. So that's
Okay.
why for the past financial years, they do not have the breakup. So they are just going to now estimate that, okay, these are suppose there are 10 floors, and suppose there are like 5 companies overall 10 floors, then that's how they're going to estimate now. But they do not really have how much their floor and their office is consuming. So right from the very first, you would probably think scope 1 and scope 2 is very easy. It's just cakewalk. But no, even there you get some unexpected challenges. And then however number of resources you have, but if you do not have that base data, you'll still have to do some arrangement. You'll have to now put a meter for your own floor and such things. So the first time struggles are a lot. And then there is one more struggle that suppose the first time you have identified, say, 3 categories of scope 3, probably, or three sources of waste. So you identified how much paper waste you are generating. You identified how much plastic waste you are generating. That's probably you identified, but you did not identify how much water waste you are generating, how much hazardous waste you are generating. So you probably already did waste number you have already published. And now next year, you probably identify some more sources of waste. Then now next year, you are supposed to comment that, okay, these are the waste that we had captured until last year, but this year we have captured more waste. And that is why instead of reducing, the intensity is increasing. So such struggles you would face, that instead you have already said that, okay, we'll reduce the intensity by 5%, but probably you identified more source and that's why your intensity is increasing now. So there are like n number of challenges which you would face in the initial couple of years of ESG reporting.
Okay. Okay, we can move forward to the next topic.
Yeah, and coincidentally, this the next topic also addresses what are the complexity challenges and why sometimes manual ESG reporting doesn't suffice. So yeah, these kind of are very understandable already, but there are some data fragmentation crisis. For example, you have like multiple facilities and multiple scopes. You have multiple sites, and it is very difficult to accumulate data in the same format, in the same unit from all of the sites. Then there are very different labor practices across your sites. Suppose you are operating in different countries, and there are some labor protection laws in some country where probably you are supposed to have some unions. And that's why you have some unions in some of your sites, but in the others, you do not have any employee unions. Or there is some diversity diversity rules in some countries, so you're following that, but you're probably not following the same across other regions. So there is a lot of discrepancy across sites and across facilities. So then there are framework challenges where you do not know which framework you want to choose, or probably once you did the GRI framework and now next year probably the IFRS S1 S2 is mandated. So you probably think that it's all in waste now because we did all the hard work for GRI standards and now we have to adopt another standard. So these are some framework level challenges that you would face. Although a lot of countries, they are trying to incorporate a couple of frameworks in one, but it is still not happening. It is still very different. So this is one of the challenge. Then there is this assurance and audit pressure. So with time, companies are being mandated to do the assurance and audit also. And this may be difficult because once you already have probably publish your reports, and now once again they come and ask you, okay, where did you obtain this data from? Can you please show us the source of this data? So this is again just added effort for the same report. So you're not doing anything new in the report. There is just one assurance certificate that will be added at the end. But for that, you have to probably go through all the numbers once again. So these are all the challenges. And that is why it is easier to have a tool in place where you have all this in place. So it is very easy now to show it to your auditors, for example, or anybody who comes and asks you for the source of the data. Next, we'll go through how AI is entering as a game changer in the ESG data management system. So like all the other sectors that AI is entering, AI is also revolutionizing the ESG reporting landscape. And it's now very easy to do automation at scale because the AI systems can process vast amounts of structured and unstructured data from multiple sources very, very fast at the same time. And it's now easy to incorporate all the data from various resources. There is enhanced accuracy and validation automatically because of machine learning and algorithms. It will automatically highlight that, okay, this has probably some discrepancy. Can you check this data once again? So it will highlight all your outliers and you will have more accuracy in your data. It's also free of the human anomalies. It's also free of the human error. So that is something that is also helping. And the predictive analytics for the strategic foresight, that is one more thing. AI transforms ESG reporting from a backward-looking compliance exercise into a forward-looking strategic intelligence. That means you probably have the data right now, you have the performance of last couple of years, and you automatically have the prediction. You have the optimistic prediction, you have the pessimistic prediction, as well as the realistic prediction of what might happen. It probably even tells you that, okay, there is one such thing happening here, some new mandate is coming, or some new rating mechanism is coming, and this will probably be useful for us from next year. So it will give you more insights automatically in the process of calculating and data management. So AI is being used very widely currently across platforms as well as by the ESG professionals. These are 6 AI trends that are transforming the ESG reporting today. First is the predictive risk detection. As I said, there are advanced AI models that analyze satellite imagery, they analyze the weather patterns, they analyze the supply chain data, and they kind of help you to do the risk assessment and strategic planning. They do smart data capture and processing. So using the natural language processing, they would extract the structured data from diverse documents, and they would read all the images, they would read all the reports, and they would have one smart data captured in one, like whatever format you want, you can just give them in pie chart, and then they would give you in the table format. So it's very easy now. You do not have to do all those things manually now. They will also give you actionable insight generation. Yeah, there is one more thing, which is dynamic peer benchmarking. So you can just train your models to follow the trends or follow your competitors, and it will keep on giving you the analysis of your competitors in real time. If they just publish their reports today, it will you were asking this question, right? How will greenwashing be detected? So with AI, now it has become even easier to detect greenwashing. So now your competitors don't need to do it manually also. They can just run your report through AI and ask AI for any discrepancies. So that's all. Now also one more reason to not actually do any greenwashing. And yeah, there is this compliance monitoring. AI can constantly check if there are any new compliances that have come up, and whatever might be required for the particular sector that the company is in. And yeah, once the last top point is enhanced transparency and stakeholder trust, because AI-powered platforms provide consistent, comparable, and verifiable ESG data, because you can go back to the source where this data came from. You can actually go and check that, okay, if anybody did any mischief, if anybody misfed the data, you can always check that, okay, who fed that data when and what wrong data was fed. So it's very easy to now, it's very easy to do audit also of such reports now. This is once again technology-driven ESG success stories. These are just some great case studies across industries and regions, how AI and how technology is transforming the whole landscape. So the first one is European CSRD pioneers. Several large European firms have successfully done the CSRD requirements by implementing ESG data platforms, and it has just become very easy for them now. Even the company that I was working before this, we used to operate on Power BI, and then it was also linked to an ESG tool called, I forgot the name, but it was directly linked to an ESG tool, and whatever, say, water data, like the meters that are kept for water, whatever meters are kept for electricity, whatever meters are kept for whatever product, plastic, etc., So all the data it directly used to pull from Power BI, and it automatically used to do all the calculation. It automatically used to highlight if, for example, someday you have more water consumed than normal. If someday you have more electricity consumed than normal, then it will also highlight. So we can directly check on the site what has happened. So it's becoming very easy to do all these things. So same thing for any framework, for anything, technology is helping a lot. This is how the ESG reporting is going to change the businesses, how it is going to change from just a mandatory reporting to a strategic help. So it's very clear that technology will transform ESG from a compliance burden into a strategic asset, which is driving innovation, resilience, and competitive advantage. Because if you are doing something in a more sustainable way than your competitor, then automatically in the years to come, you will be having some strategic advantage over your competitor. So 2025 and 26 is probably going to be the foundation phase where the organizations will be establishing robust data infrastructure, data collection platforms and infrastructure, where they will be working on automating the compliance processes using AI, using tech tools. They will be integrating the sustainability metrics into business operations. So as I said, so business operations, you're probably measuring how much water you are consuming. Probably you are measuring how much plastic you are consuming. So now whatever data is needed for ESG reporting, that will also be integrated in the operation itself. And the sooner this is adopted, the better it will be for the company. Next 2 years, 3 years, say 2027 to 2029 will be the intelligence phase, where AI and machine learning will be the primary, they will be enabling the predictive analytics, scenario modeling. They will be doing real-time sustainability monitoring, and the data will become the integral part of the planning and of the product development, investment decisions, strategy, everything. And then 2030 is somewhere where we think that the ESG metrics will be fully integrated with financial reporting. And the way financial reporting is a very normal thing for all the small and big companies right now. The same thing will happen for ESG reporting, and yeah, that's how it will be integrated probably somewhere after 2030. This is something that we think will happen in future, and what you can do to be the leader in this game is just embrace technology to lead the disclosure landscape. So you are supposed to identify what kind of tools help you the most, how you are supposed to how you are supposed to use sustainability as investment, attracting the investment, and how you are going to be future ready using this. So this is one such thing that you can do to be in the game in the front. This is just a list of some tools that are used across the globe for carbon accounting. These are some sector-specific carbon accounting tools. EcoVadis is more of a rating mechanism. It is also widely accepted right now. It is just not just a rating. It is actually being mandatory because the customers or the suppliers who are going for EcoVadis, they are actually forcing all their upper and the upstream and downstream suppliers to go for EcoVadis, because EcoVadis has this requirement that automatically the data has to be linked from all those suppliers, and it will give one final rating for the main client who has registered for EcoVadis. So there we are getting a lot of clients right now who are just coming to us because their suppliers or their customers are asking them to do EcoVadis because they want to incorporate their emissions in their in the main client's emissions. So these are some tools for the life cycle assessment. These are some tools for the complete ESG reporting. They would probably do, you just have to fill in the data, all your E, S, and G parameter data you have to fill, and they will give you some idea and some output in terms of everything, calculated emissions, calculated turnover rates, And they will probably also tell you what training is required for your employees, what kind of supplier engagement you need to do, what kind of more ratings you need to have in order to be front in your game. So these are some tools. And yeah, I'm very close to wrapping the session up. I have like probably 2 slides more with the conclusion. So if you have any questions right now, we can take, or otherwise we can take after the next 2 slides. I'll just finish quickly because there's nothing much. It's just a conclusion slide. So yeah. Can I go ahead?
Yeah, one question we have is with respect to scope 3 emission. So in for collecting data for scope 3 emission, we have to depend on the data shared from our vendors or third party transporters, travel partner. So how do we verify the authenticity of data, or what are the challenges?
Yes. So there are 2-3 methods. One method is, for example, you are buying a total of 100 kgs of plastic probably, and out of which you have got like 20 kgs of plastic you are buying from one supplier, another 30 kgs of plastic you are buying from another supplier. So that one method is to analyze if the data is matching. So if both your suppliers are based out of, say, the same city or same country, and if there is a vast difference in the numbers that they are giving you, then you have a problem. Then you probably need to go check yourself. Second method is to ask them to give you audited numbers. So they will have to do the hard work of getting it audited by a third party, but then you are safe and you are just secure that, okay, these numbers are audited and I can use it for my calculation. And that's how you can go ahead with this problem. And second is, you can probably have some supplier engagement activities where you are telling them that this is how we want you to, like, probably this is the emission factor that we want you to take care of. Or you can go and do the audits. Okay, if this is what they're saying, is this really in place? If they are really following those data protection systems, you can go and check, do the audit yourself. These are the only methods that you can follow.
Yeah, thank you. I
Okay.
think so you have already answered our questions.
So
Yeah, you
yeah,
may
so this is the conclusion. I have one more slide. These are kind of just concluding statements. I'll take like 5 minutes more, maybe. And I just
Yeah.
like to
Okay.
conclude. Yeah.
Yeah, continue. Sorry.
Yes. I just like to conclude by saying that the era of voluntary reporting has ended, and the ESG disclosure has evolved from a nice to have communication tool into a fundamental business requirement that influences access to capital, regulatory compliance, customer relationships, and competitive positioning. So this is something that is already happening, and it will happen even more. So it is not just something that you need to do. It's not just something that you would like to do for a goodwill or a good image, but rather this is now going to also question your competitiveness and your business capability. So by default, you would be outsmarted by a supplier that is giving the same kind of quality, but with more better sustainability related performance. So that is what is going to happen later. And the 3 things, if you want to kind of generalize it, then you need to build stakeholder trust. It may be internal, it may be external. Both the stakeholders you have to build trust, and you have to follow the leading frameworks like GRI, SASP, TCFD. If you are doing Europe, then you have to do ESRS. Then if you are wanting to incorporate full financial performance along with your sustainability and climate related disclosures, then you should follow ISSP. So these standards will provide credible foundations for transparency and accountability. This is something that you need to do. You should avoid getting your own frameworks. That is also fine. That is also actually encouraged. But sooner or later you need to move to the widely accepted frameworks. Then you should enhance your business resilience by comprehensive ESG reporting, as it enables better risk management and opportunity identification across all business areas in your upstream as well as downstream supply chain. And lastly, you need to leverage the digital innovation that is happening right now. You need to have AI systems in place or digital tech tools in place. Otherwise, very soon you will be running out of the manual capacity to do the reporting. So this is something that you need to do. And lastly, the future of ESG reporting is going to go ahead from integrated financial. So the next step probably will be integrated financial and ESG reporting. Then it will go ahead and probably be advanced analytics and AI applications that will enter the landscape. And yeah, so somehow, somewhere it will be at a place where everything is being automated, everything is advanced analyzed. And you have to be prepared right now in order to be in the game later on. And lastly, you should focus on enhanced transparency and verification, because stakeholder demand for transparency is something that drives the adoption of third-party assurance, real-time disclosure platforms. So this is all that will probably come up later on. And this is where we think the ESG reporting is going towards. And the organizations that thrive in the coming decade will be those that recognize the ESG disclosure not just as a compliance burden, but also as a strategic capability that drives innovation, builds trust, and creates sustainable competitive advantage. Thank you.
Thank you, Namrata. It was really good, insightful session. So we have few questions before we wind up the session. Just a minute, let me just search. So, so there is one question based on the how do sustainability disclosures align corporate strategies with UN SDGs, Sustainable Development Goals?
Okay, so see, I actually have that in the next slide. But I thought I will not cover it as it's very yeah. So your question is as how are the companies aligning their sustainability
Corporate
strategies
strategies,
with the
yeah.
UN? Yeah,
Yes.
yes. So what companies are doing right now is that, for example, if yes. So for example, the previous company that I was working for, so this was the issue that we were the water intensive product was the issue that we were solving, and we kind of aligned it with clean water and sanitation problem. So because the plants were located in a water scarce area, so that is why we kind of thought that, okay, those plants shouldn't be consuming more water now. They should be manufacturing such products which consume less water or no water, near to no water. And that's how we addressed this issue. When we published the report, we said that we are addressing this issue because at this place, there are people who are struggling to get clean water. And by doing this particular step, we are trying to solve the problem of clean water and sanitization for the communities near that plant. So this is how it was linked. Likewise, if you are probably doing, say, if you are doing if you're generating renewable energy in your plant and you are consuming more renewable energy than the non-renewable one, then you can of course link it with the SDG goal number 7, which is affordable and clean energy. So that is how you have to identify which SDG can be linked to your effort, and accordingly you can put it in your report.
Okay. Okay, there is one more question. So there is a question which is asking that why is greenhouse gas accounting central to climate-related disclosures?
Okay. So the main thing, so for example, yeah, see, if you go through this slide, then this is the slide, this is the list of all the global risks that are, as per the World Economic Forum, global risks, these are the risks which are actually going to be very severe in the short term as well as in the long term. So this 2 years table, these are all the risks that will be very severe in the next 2 years, and these are all the risks that will be severe in the next 10 years. So if
Okay.
you would see all the environmental risks that are highlighted in green here, so one is the extreme weather event, one is pollution, and over the long term, the extreme weather events and pollution remains, and there are new biodiversity loss and ecosystem collapse, critical change to earth systems, and natural resource shortage. So currently, all the greenhouse gases are being monitored because the extreme weather event and pollution. We foresaw this quite some time back. So that is why all the mandatory disclosures that came around this.
Okay.
So this is why currently the GHG emission is one of the major part of the environmental reporting. And over the next couple of years, so I probably already showed you in the environmental KPI list that biodiversity and ecosystem related KPIs were also added. Then the critical change to earth system and natural resources shortages KPIs related to this were also added. So over the years, that will also add up. But currently, these are the ones which we are trying to fight. The extreme, the second one, and this sixth one, the pollution.
Okay.
Yeah.
Yeah, the slide was pretty insightful.
Yeah.
Also, the last question for the day is discuss the significance of GHG protocol as global benchmark for emission accounting.
Okay. So I'll go back to the difference slide between GHG and the ISO. So currently there are only two items, so two standards in place, which are telling or which are widely accepted and which are widely used for calculating the emissions. So ISO is something that requires certification, and there are a lot of difficulties that come with ISO. But GHG is something that is very easily adaptable. It also tells you, so for example, if I have it, one second. Yeah, so this GHG protocol is something that is industry developed, and it started as a voluntary framework. It was led by the World Resource Institute. There were a couple of more institutes which developed it, and it was developed by the industry for the industry. And it is more prescriptive and detailed. It tells you how to calculate and how to make the inventory of the scope 1, 2, and 3. It kind of is more easy to understand. It also tells you in a very detailed manner. Whereas ISO is actually set up by the ISO, the International Standard Organization, and it tells you what to do. It doesn't tell you how to do it. So that is why automatically it was more easy for everybody to adopt GHG protocol over the ISO, because ISO again requires more money, more certification, and is more time consuming also. So that is why whoever wanted to start as a mandatory requirement, they all went for GHG protocol. And it was also widely accepted by CDP, BRSR, IASP requirements. They offer, they also ask their clients to go and refer GHG protocol to do the emission calculation. So that is why so the question, sorry, can you repeat the question?
The significance of GHG protocol as global benchmark for emission accounting.
Yes. So yeah, so that is where I'm going with. So because of all such reasons, being cheaper, being faster, all such advantages, GHG just came very quickly to all
It is
the
easy to implement as well, as you mentioned.
Yes. So it is actually, as the name suggests, it is just a protocol. So it just tells, so you go to it with a doubt and it solves your doubt. It doesn't mandate you to do anything. It doesn't ask you to spend any money. It's essentially free. It doesn't ask you to get any certification or anything. So that is why many leading Indian companies are, so not just Indian actually, all over the world. That is why they are adopting it.
Okay, and one last question. So you mentioned about this Effitable something, right? So one of the client is. Can you just just let me know, just let us know the importance of why that rating is important for your for the customers who's dependent on that rating.
Got it. Yes, yes. So EcoVadis is something it is similar
yeah, sorry.
to
I
yeah.
pronounced it incorrectly. Yeah.
Yes, yes, no problem. So EcoVadis is something that is so if you would see the list of all the frame 1 second. Where is it? Where is it? Yeah. So it is nothing but a rating, and it is not the only body that is giving you the ratings. There is CDP that is giving you ratings, there is MSCI that is giving you ratings, there is Sustainalytics that is giving you ratings. So there are a lot of this is Dow Jones Sustainability Index, that is one more rating mechanism. So essentially there are a lot of ratings available in the market. But the reason why EcoVadis is emerging as one of the most sought after ratings is because it is targeting the big companies, and it is so basically it's entering the supply chain. It is focusing on the supply chain. So for example, if I am X company who is some say medical company who is taking some raw material from somebody and going ahead for giving my finished product to somebody, then it asks me if I want to register for EcoVadis. Then I am forced to give all my suppliers as well as my customers to enter EcoVadis. That is how they are operating right now. So essentially, because of their operating mechanism, they are widely sought after. So essentially, probably
So more trustworthy in terms of rating.
yes. And so if the company wants to be in business, then it will do EcoVadis. Otherwise, that EcoVadis applicant will just find another supplier who is doing EcoVadis. So that is why now everybody either needs to do EcoVadis or they'll probably be replaced. That is why it is being more widespread currently.
Got it. Okay, so Namrata, we are done with our questions. So we'll just end our session with a small note. Good. Thank you, Namrata, for a wonderful session. Good evening, everybody. On behalf of Sustainability Reporting Standards Boards of ICI, extend my sincere gratitude to all the participants for joining today's informative and engaging session on sustainability reporting and greenhouse reporting. Your presence and active participation made this program meaningful and successful. I would like to express our I would like to express our special appreciation to our distinguished speaker, Ms. Namrata, for delivering an insightful and well-structured presentation. Her guidance on sustainability reporting framework and greenhouse gas reporting, along with practical perspective on measurements, disclosures, and compliance, provided valuable clarity to all the attendees. The sessions effectively highlighted the growing importance of transparent sustainability disclosures, accurate GHG accounting, and alignment with national and global reporting standards. Ms. Samrata's explanation helped participants understand the role of sustainability and emission reporting in driving responsible business practices and informed decision making. We look forward to your continued to all the participants here. We look forward to your continued association and to welcoming you at our upcoming programs focused on emerging developments and best practices in sustainability reporting and assurance. Thank you once again for your valuable time and participation. Thank you, Namrata.
Thank you so much. Thank you for having me. And thank you everyone for being such a good audience. Thank you.
Thank you for listening to our questions patiently and answering them.
It was my pleasure.
Have a great
Okay.
day.
Same to you. Have a good evening and a good weekend ahead.
Yeah, bye. Take care.
Bye.